All right, so just to recap for everyone on this video, we're finishing out the quarterly model. You've missed a bit, but basically we've changed this to quarterly projected for 2020 and 2021. And so a lot of these will be summations of the 4 quarters here. And then these formulas will be copied from before because we're not actually calculating the 2020 years or the 2021 years. We're calculating them off of the quarter years. So you kind of have to apply that accordingly. And then so what we've done and we're working on is we're applying growth rates and margin rates and stuff like that we've already done so far in the annual model to quarters. But the one thing to remember is if the numbers look off, it's because you need to divide them by, you either need to divide them by 4 or multiply them by 4. So for example, number of restaurants during the period, it stays the same because each quarter there's the same number of restaurants. An average sales per restaurant is an annual number, like they're trending towards this number per year. So in order to kind of roll up revenue, you go annual average sales per restaurant times number of restaurants divided by 4 because it's just a quarter, right? So we're doing that kind of across the board. So right now we're picking up on is the balance sheet, metrics that we drove here, which is kind of a pain, but okay. So well, we've kind of copied that across. These are all quarterly projected numbers now. So operating model times that. So now we can kind of copy these across. Oh, I cut that, didn't I? So there's 1%. See, so for example, right, balance sheet numbers are generally, think of them as annual. So percentage of sales is 1% of sales here on the annual column. So here, if we still want 1% of sales on an annual basis, we got to multiply that by 4. Or we could drive it by saying 4%, right? But I think it's more applicable to say percentage of annual sales, right? So times 4. -2. Oh, that'd be a negative number. Income taxes receivable. Q3. Provision for income tax. Okay, so this is kind of a funky number. So we're going to keep this one annual because quarterly taxes aren't generally paid on quarters. So we're just going to keep this one here. So, and again, balance sheet numbers are, I guess we can average them, right? Or we would average them over the year. Yeah, that's what we do. Because balance sheet numbers are static, and you're applying either annual or quarterly numbers to them. taxes receivable. So we're going to keep that static, like we said, right? As an annual number. Accounts payable, we can apply ×4. What? I guess that's right. Drop that in. Accrued payroll benefits, same thing. Drop that in. ×4, right? ×4. Five ×4. Okay, so now we can hook it up, except for income taxes receivable. K17. Why is that pointing there? That's weird. I-17, J. Oh, sorry. K88. Okay, that'll be fixed at some point. So, okay. Hard work. Late nights. And so obviously here, quarterly projected since balance sheet numbers are a snapshot at the end of the year, it's not going to be an average, right? It's going to be the end, what it is at the end of the year. So it's going to be that. And it's going to be that. And so income taxes receivable will be equals it's really interesting. Okay, so I guess we should do something. Why 88? Yeah, so income taxes receivable get kind of funky. So what I would just do here is just run it annually. So what we do is denote this in red. So income taxes receivable, I would just go and then it does look like that's going up. So let's just do like 10. I don't know why. All right. So, and what we just do here is omit this. It's kind of funky. What would I do here? It's been a while. Okay, let's come back to this. These we're just keeping static. These we're keeping static as well. These are pulling from here. And then these are going to be pulling. I guess we just do that. These we're just keeping static. And this is the same formula. Although I believe this is something we keep. This one pulls from the end of the year. Great. This would go here. We copy that across. So stockholders' equity, we're copying that across because stockholders' equity changes. We increase that by net income and by stock-based comp and subtract dividends. So that can be done on a quarterly basis. Okay, so that's built-ish. We still have to come back to this. And what we're doing here is we're just going to copy these black numbers across because they're the same formulas. Stock-based comp expense, other assumptions. Okay, so we'll just do this. Stock-based comp. Divided by operating model. Yeah, that should be fine. 6. So this is a summation because it's cash flow, right? We did averages because it was balance sheet, because balance sheet's a snapshot. And now we're doing summations because cash flow and income statement are over time, the full amount. Like you make money during certain periods of time, and it's not a snapshot. Okay, so we copy this across now. Deferred income tax benefit. Interesting. Okay, so this is all going to be copied across. I'm going to go an hour and a half. You guys can all drop off whenever you want to. So now we're projecting CapEx per restaurant opening. And that's going to be year over year growth rate times 3. Or maybe not. CapEx. Yeah, we didn't have the cash flow statement here. So we'll probably just do it quarter over quarter for now. And just kind of zero that out. Or maybe 1.25%. 5%. 0%. We're going to delete these, right? Sum of the year they're in. I rarely have done 3-statement quarterly models. This is a tough one. And if you're confused by a lot of what I'm doing, like don't be concerned. It's pretty understandable. Like I'm trying to figure this out myself, like after not doing it for so long. And I don't think I've ever professionally done a quarterly 3-statement before. Maybe during some case studies, during interviews, but I don't think I've done this in a while. Almost done. Okay, so this is a quarterly model and it's dividing by number of openings. Okay. I mean, this is probably something we should do annually. So I think the takeaway here is just some things I wouldn't drive quarterly, like CapEx per restaurant opening per quarter, because we just don't know embedded in this CapEx number how many openings they're still doing, right? They do tell us they're opening 25 that quarter, but they're probably working on some of these, right? So, I guess we could get around it by saying, yeah, I think I would just ignore this in driving it. Just more accurate. And so for this stuff too, I'd probably just cut it. So I think the where I'm kind of struggling here is the fact that they do, like, cash flow statements are messy, if you see this, right? So they are spending money on purchases of investments and maturities of investments and some of this stuff. So what I'm just going to do, and this is like kind of cheating, is just delete the first part of this year on the messy stuff that I don't want to drive quarterly, and just kind of because it's not going to affect our DCF at all. Like, we don't really care that much if they're purchasing investments or if investments are maturing. They're just doing that to manage their treasury, I guess. So I would delete some of these things that you don't want to drive quarterly. And so, but obviously keep the things that you do want to drive quarterly here. So that's that. And so the reason why I'm doing that is because we need to balance the balance sheet. So when this happens, that plus that net income. That's divided by 0 because this is divided by 0. Dividing by 0. Oh, that's the reason. Okay, so again, I'm not going to, let's just not drive taxes by quarter because it's not really applicable. And so we'll just drive it by annual. Interest income. All right, so now here's a good real world problem. We have a sort of reference error, right? We got dividing by 0. Yeah, didn't want to do it so long. And that's driven because cash isn't being calculated right. So let's see. So let's try to diagnose this problem. So we got net income here is a 0 because interest is a 0 because cash is a 0 over here because, and cash is a 0 for no reason. So this is where you'd have a circular reference check or circular reference switch. So you can go equals, let's do a circ. circular switch. Sometimes references flip up on you, like they'll ref out for no reason, like not for no reason. It's because you were doing referencing and it got really confused because it didn't refresh itself. So we're going to name this one circ. And if that ever happens again, you can put your circ plug in cache and cache equivalents. So equals if circ equals 0, 0, that. So that means that if circ is 0, it's just going to zero out the cell and refresh the cache cell. And if it's 1, then it'll just work like normal. Right. So all you got to do next time that happens is you just got to go 0, 1, 0, 1. Cool. So that fixed our quarterly model. And so let's see if we can fix the rest of this model. Okay, so that's that. We really have to error check this model. I'll probably do that on the. So that's referring to this. So that's 0 because that's income taxes payable is dividing by 0. And that is other assumptions. Okay, so that's that. K88. Interest income. So we want to copy that circ on cache. So we need to fix income taxes payable for sure. So net income is now K86 times see how the circ kind of worked. Okay, I know I'm not explaining a lot of this that solidly. So if you're following along after the fact, just message me or DM me. I can try to explain. Usually, like we're going way overboard on a quarterly 3-statement model. It's rare. I've never seen that actually. So we're not balanced by a little bit. That's because I'll probably find that sometime later after the call. But that's generally the 3-statement model quarterly. We've driven a lot of this quarterly, right? And then we've deleted some of these quarterly, the first couple quarters of the things that we want to drive annually, because some of the stuff I just don't know. And I'll have to think a little bit more on some of these line items. But for the ones we do want to drive quarterly, we drive quarterly. For the ones we want to drive annual, we've kind of cleared out the annual, and then we're going to drive annually. So that should be fine. And so now we kind of have to just catch the culprit of what's not balancing. And income taxes payable, receivable. Oh, so we do this. So equals other assumptions. We're doing income tax receivable. We're doing that. Annually. So we want to delete this guy. Yeah, I'm not sure where this 0.8 is coming from. I'll have to figure that out. 16.27. Oh, here it is. So equals. Kind of in the theme of these being annually run. Oops, I did that on the wrong one. Tax payable. It's interesting. All right, I'll have to fix this next time. I don't even know if this video is worth posting because it's a lot of like kind of grunt work on the quarterly model. But I mean, we're almost balanced here. I got to really error check this. But now that we have a quarterly and kind of annual model, now that we like off of this, we could very easily build a levered free cash flow model or a unlevered free cash flow model. Yeah. So, I mean, in reality, what's going to happen is people like projecting quarterly stuff for revenues and stuff, and potentially CapEx. But other than that, you know, I hate to have wasted your time, but a lot of this is like people aren't really projecting quarterly balance sheets at all. And people don't project quarterly cash flow statements at all other than potentially CapEx. So in reality, what we'd do is we'd clear all this and clear all this and clear this, and then run most of the projections on the income statement or on the annual model, but just kind of use the quarterly to build to certain key assumptions. But what we did do is we almost built a full quarterly 3-statement model. Some of the things, if you haven't noticed, are confusing because, for example, like income taxes per quarter just flip-flop a ton. I mean, they're getting positive benefit from income taxes in these quarters. So what's happening is it kind of flip-flops on the quarterly basis, but on the annual basis, it's generally the same income tax rate over the year. So just keep that in mind, which is why we wanted to project this per year. And so the one thing I'll have to track down, unless someone here has a fix they've noticed, why our model is not balanced. And so we'll have to figure that out. And it's by such a small amount. I mean, it's by 2 decimals in. So the asset side is much higher than the liability side. So what is this number? 0.0082. I mean, do we have a 0.0082 somewhere hiding? Oh, there we did. We have it right here. Bad debt allowance. That's what we have. Got that. Interesting. So we fixed it. And the reason for that, bad debt allowance. Yeah, we don't really even want to do that. So we're just going to probably just delete this out, right? And project this quarterly. This is something we want to project quarterly. Okay, so we fixed it together. So now we're completely balanced. We've kind of not projected these cash flow from investing and cash flow from financing. We'll keep this in here because, well, we probably won't keep this in here. Well, so now I got to keep that in there. Just keep it in here. And so we're kind of only projecting the things that we care about here. Now, the last thing that we should do and tie up is, okay, so DNA is now fixed, but it's really high. It's artificially high. So 6.1 in years divided by that, you got to divide that by 4. So now it's error checking time, right? We did a bunch without actually checking errors. So does this look generally good? This looks generally good. This looks generally good. I mean, it's probably could serve to do this. Generally good, generally good, generally good, generally good. Okay. Okay. Pre-opening costs. Where is this coming from? We can kind of project this out. Copy last year's. Fine. These things don't affect valuation that much, but it's always good to be. Maybe that's like 3%. Guess they're buying securities. Provision for income taxes. Yeah, we're not doing that. And income taxes receivable. We were projecting annually. Okay, so now it's unbalanced. And the reason why is because income taxes payable and receivable. So that's doubling up somehow. Oh, maybe this is why. So I know you guys can barely read the numbers, but I'm basically trying to reconcile income taxes payable and receivable with income taxes payable and receivable, these two line items. But the fact of the matter is we didn't want to project these numbers quarterly, right? So we kind of have to delete these. But now we're off by that amount, right? So, which is tough on the income statement. Which we want to reconcile. So let's just equals that. We're just going to keep income taxes payable the same, or maybe just average them for the last 2 quarters. And so we're balanced on the quarterly. And this is 77. Oh, okay. I see what it is. So we have to go equals, we have to reconcile this to the end of the quarter. So we have to go equals end of quarter balance equals end of quarter balance. What is going on? So yeah, I just used the circ because it circled out on me. And I think we're balanced. Sometimes it does this. Okay, we're barely not balanced. But we're basically balanced because the way that iterative calculations work is that it tries to calculate it over and over and over again until it reaches 0. So there we know we're balanced. Cool. Okay, so now we have a fully balanced 3-statement quarterly model where we've kind of cheated a little bit. We're running all of the income statement stuff quarterly, which is great. That's really what we want. And we've kind of run the balance sheet quarterly, but we are running, I guess we're running this whole thing. Yeah, quarterly. The whole balance sheet is running quarterly, but the cash flow statement is running quarterly for some things, but on other things, we've just decided to run it annually. So whenever we've had to do that, just remember we're deleting these things, and I'll fill them gray because they do have numbers as per the filings, but we're just kind of deleting them because we want to just kind of X them out because they're kind of immaterial, and it's just super complicated to try to estimate these like bad debt allowance or impairment or income tax provisions by quarter. So we're just kind of Xing that out. And then all the movements on the balance sheet on the balance sheet is captured in the changing of balance sheet accounts here. So I know that was not super. Oh, actually the one last thing we wanted to do is do CapEx. So we do want to do this. Okay, so I saved a new version for a reason. So this is the old version. And I just want to copy this down. All right, and then kind of increase it quarter by quarter. Maybe just all right. Well, that's it. That is it. Quarterly model running, quarterly balance sheet running, cash flow statement sort of running quarterly on certain things, but for the things we just don't want to deal with, we just deleted historical 2020 and deleted it through here so that everything balances. Hopefully that made sense. See you next time. Stop.